Welcome to the deep dive. We cut through the noise to get to the insights that, well, really matter.
That's the goal.
And today, we're jumping straight into a pretty big debate. It's all about Bitcoin's institutional embrace.
Right, this whole new chapter.
Exactly. We're digging into this really sharp panel discussion from BTC 248, Bitcoin's institutional wave. It was at Baltic Honey Badger. You had Willy Woo, Max Kai, Efert Fenixson, Preston Pysh. Quite the lineup.
Oh, yeah, some heavy hitters there.
And it was lively. You know, you had these powerful arguments about the opportunities, huge opportunities this unlocks, but then equally strong warnings about the risks, big risks to Bitcoin's sort of core ideas.
That classic tension, right? Mainstream acceptance versus staying true to the original principles.
Precisely. And that's what we want to unpack today. Our mission really is to navigate this institutional wave, pull out the key arguments, the facts that maybe surprised us, and what it all means.
Yeah, not just what's happening, but why it's such a big deal for all of us interested in digital assets.
Oh, okay. So let's start right at the epicenter, you could say, BlackRock's spot ETF.
Can't really avoid that one.
No. Anyone following crypto knows this wasn't just another product. It felt seismic. The panel kept calling it a cultural and capital tipping point. But, okay, for our listeners who get what an ETF is generally, what made this one, from BlackRock specifically, such a game changer? What did it really unlock that maybe others couldn't?
That's a great question because it's not just about the ETF structure itself. Think about Bitcoin before this.
Yeah.
Accessing it, especially for big institutions, was like trying to drive a massive 18-wheeler down a winding country lane.
Okay, I like that.
Possible for some, maybe, but slow, difficult, maybe a bit risky, definitely not standard practice for, pension funds or huge endowments.
Right.
What BlackRock did wasn't just pave the road. They effectively built a 6-lane superhighway straight into Bitcoin, specifically for institutional capital.
Ah, okay. The highway analogy works.
And it's BlackRock. Their size, their reputation, the trust they have within traditional finance, it's immense.
Unmatched, really.
Pretty much.
Yeah.
So when they offer a Bitcoin ETF, it sends this powerful signal. It basically says, okay, this asset class is legitimate. It's investable. That's the cultural shift. Bitcoin goes from niche tech thing to something discussed in boardrooms.
It normalizes it.
Exactly. And the capital tipping point. Well, suddenly trillions of dollars sitting in traditional accounts, previously blocked by regulation or just lack of easy access, now have a compliant, familiar on-ramp.
The highway entrance.
A highway entrance is open, and that changes everything: liquidity, market dynamics, the whole ecosystem.
Okay, that paints a really clear picture, but building a highway also means you need traffic rules, right? Naturally. The panel spent a lot of time on the regulatory side, specifically the SEC and this whole debate around in-kind redemptions. Now, this might sound a bit technical, but why was this such a sticking point? And what did the SEC finally allowing them really mean for, like, market health?
Yeah, it sounds granular, but it's actually fundamental. In-kind redemptions simply means when you sell your ETF shares, you get the actual underlying asset Bitcoin back, not just cash.
Okay, get Bitcoin, not dollars.
Right. The SEC initially pushed for cash only. So you sell shares, you get dollars.
Why was that a problem?
Because, as the panel stressed, it risks creating a kind of paper Bitcoin. The ETF shares could potentially trade slightly disconnected from the real Bitcoin price. It weakens the direct link.
Ah, okay. Like a synthetic market almost?
Sort of, yeah. It hinders true price discovery because the arbitrage mechanism where market makers can create or redeem shares by physically moving Bitcoin doesn't work as efficiently. That direct link is what keeps the ETF price tightly tethered to the actual spot price of Bitcoin.
Makes sense. Ensures it tracks properly.
Exactly. So the SEC eventually reversing course and allowing in-kind wasn't just a technicality. It was a big deal for market integrity. It means the system is more robust, more transparent, and you can have more trust that the ETF truly represents underlying Bitcoin.
Got it. So making sure the paper claims are, well, solidly backed by the real thing.
Precisely.
Now, moving beyond just the ETFs, the panel also highlighted this boom in corporate treasury strategies. This is different, right? This is companies like MicroStrategy actually holding Bitcoin on their balance sheets.
Yeah, a significant shift. It's not just financial firms trading it. It's operating companies deciding to hold Bitcoin as a reserve asset, like they might hold cash reserves or even gold.
What's driving that?
A few things, likely. Hedging against inflation is a big one you hear. Diversification away from just dollars or bonds. A belief in Bitcoin's long-term potential as a store of value, maybe even signaling their forward thinking.
Okay. But the panel wasn't all celebratory about this institutional rush, were they? What were the main concerns, the sort of against perspective that came up?
No, definitely not all sunshine. There were some pretty sharp critiques. A major one was the Coinbase custody concentration.
Right, you mentioned that earlier.
Yeah. While it's convenient for these big companies to use a trusted custodian like Coinbase, it means a lot of institutionally held Bitcoin is ending up in just a few hands.
So much for decentralization.
Well, that's the uncomfortable question the panel raised, isn't it? How decentralized is Bitcoin really if large chunks of it are effectively re-centralized in these big custodial vaults?
What are the risks there?
Think single points of failure. A major hack targeting a big custodian. A sudden regulatory crackdown focused on those specific entities. A technical outage. If one domino falls, it could impact a significant portion of the market all at once. It creates this tension between institutional convenience and Bitcoin's core idea of distributed control.
That's a really sobering thought. Does the convenience potentially undermine the whole point?
It's a valid concern, and it wasn't the only one.
What else?
Another big risk they flagged was nationalization.
Wow, okay. Like government seizing Bitcoin.
Potentially, yes. The thinking goes, as Bitcoin gets more integrated, held by major public companies, maybe even seen as systemically important, could governments, in some extreme scenario, try to control or seize large pools of it?
How would they even do that?
Maybe by compelling the regulated custodians, the Coinbases of the world, to comply with state orders, especially if Bitcoin starts being viewed as like a strategic national asset or conversely a threat to their own monetary control.
Yeah.
It's the absolute opposite of censorship resistance.
Definitely flies in the face of the original idea.
Completely. And they also brought up Tether.
Ah, the stablecoin scrutiny.
Yeah. It wasn't just mentioned in passing. It was highlighted as this ongoing point of concern regarding market stability. Given Tether's huge role in trading volume and liquidity, questions about its reserves, its audits, they linger.
And if something went wrong there?
The ripple effects could be massive, especially now with all this institutional money flowing in. It's a reminder that the whole crypto ecosystem isn't uniformly robust. Institutions coming in doesn't magically fix underlying weaknesses. It just means they're now exposed to them too.
Okay, so we have this influx of institutional capital driving adoption, but also introducing these centralizing pressures and exposing new players to existing risks. It really begs the question, what's the antidote? What did the panel point to as the way to counter these risks?
And this is where it gets really interesting, where the promise and the peril meet. The resounding answer, the thing they kept coming back to as the ultimate safeguard, was self-custody.
Right, holding your own keys.
Exactly. Not just a technical detail, but almost a philosophical stance. It's like deciding to hold your own gold bars in your own secure vault at home instead of trusting a bank or depository miles away.
Being your own bank, basically.
That's the analogy. You hold the keys, you control the Bitcoin. Period. It directly counters the risk of custodian failure or regulatory overreach targeting custodians, or even those nationalization fears, because you have control, not some intermediary.
It brings it right back to that core principle of individual sovereignty.
Absolutely. It's the individual opting out of the risks that come with institutional integration while still participating in the network. It's powerful.
It really is. Now, the panel didn't stop just there, did they? They touched on some broader related topics, too.
They did branch out a bit.
Yeah.
Briefly touched on AI, artificial intelligence, and its huge impact. I think they mentioned education specifically, how AI could reshape it.
Interesting connection.
Yeah, the underlying point seemed to be that Bitcoin, like AI, isn't just an incremental change. It's a foundational shift in technology that changes how we organize things, how we interact with value and information.
And what about other digital money?
Right. They also got into that crucial debate, central bank digital currencies, CBDCs versus private stablecoins.
Okay, the future of money itself.
Pretty much. They laid out the difference clearly. CBDCs are government-issued, government-controlled digital cash. The panel raised concerns about potential surveillance, control. Your spending could be tracked, maybe even restricted programmatically.
It sounds dystopian.
It has that potential. Private stablecoins, while having their own issues sometimes, offer a different path. Generally more open, maybe more room for innovation, operating outside that direct government transaction control.
So it's a choice about control versus freedom, essentially.
That's the core of it.
Yeah.
What kind of digital financial future do we want? Total central control, or one that allows for more individual liberty and permissionless development? It's a huge question at the intersection of tech, finance, and our basic freedoms.
Okay, wow. We've covered a lot of ground here. Let's try and synthesize this. We've seen Bitcoin's institutional way bringing immense change, that BlackRock ETF acting like the superhighway for big money, driving mainstream acceptance.
The opportunities are undeniable.
But equally, we've confronted the shadows, the risks of custody concentration, the specter of nationalization, lingering questions about things like tether stability.
Real concerns that can't be ignored.
And through it all, the clear aha moment, the recurring theme from that panel, was the power and importance of self-custody. It emerged as the key, the individual shield in this evolving landscape.
The ultimate way to retain control.
Exactly. It reminds you that genuine ownership in this digital age is defined by control, not just convenience.
And if you step back and look at the bigger picture, this whole institutional wave, it's not just about price charts going up. It's more fundamental.
Yeah.
It's changing how the world even thinks about digital assets, pulling them from the fringes right into the financial core.
A paradigm shift, really.
It is. But that shift creates this inherent tension we discussed. How much of Bitcoin's original, radical, decentralized nature can survive deep integration into the traditional system? And that, I think, puts a new kind of responsibility on individuals.
How so?
Well, it leads to a crucial question, really, for you listening. As Bitcoin becomes more embedded in the mainstream financial world, what's your role in preserving the principles, the decentralization, the censorship resistance that made it revolutionary to begin with? Can we actually have both widespread adoption and that uncompromised individual financial sovereignty?
That is definitely the multi-trillion-dollar question, isn't it? Something important to think about.
Indeed.
Well, thank you for joining us on this deep dive. It's been fascinating exploring Bitcoin's institutional crossroads.
My pleasure. Lots to consider.
Absolutely. If you found this valuable, please do follow, like, and maybe share this deep dive with anyone else navigating these complex topics.
Spread the knowledge.
And for ongoing insights, make sure you follow What Bitcoin Taught Me. We're on Twitter, X, Nostr, Bluesky, Threads, Instagram, Facebook, LinkedIn, pretty much everywhere.
Hard to miss.
We try. Thanks again for tuning in, and we'll catch you on the next deep dive.